As the Secretary of the Energy and Environmental Markets Advisory Committee, it's my pleasure to call this meeting to order. This is the third EEMAC meeting with Commissioner Berkovitz as the sponsor of the committee and the first EEMAC meeting of 2020. In light of the global response, we are holding today's meeting as a teleconference to protect the safety of the agency personnel, the EEMAC members and associate members, and the public. To ensure that today's meeting goes as smoothly as possible and the recording of the meeting is complete and accurate, please keep your phone on mute upon to participate. If a meeting participant needs assistance during the call, please dial *0 for operator assistance. EEMAC member Tina Wiggins will serve as the chair of today's meeting. Before we begin this morning's session, I would like to turn to Commissioner Berkovitz for his opening remarks.
Thank you, Abigail. Good morning, everyone, and welcome to the Energy and Environmental Markets Advisory Committee meeting. This is a challenging time for our nation and financial markets. I thank the committee members and associate members for joining us today. I hope you are all safe. Recognizing our committee members' attention to current events, we have postponed our discussion on the position limits rulemaking. Instead, members of the CFTC's Division of Market Oversight will brief the committee on the recent developments and volatility in the derivatives markets. In times of market stress, it is critical that our markets be transparent and that participants have accurate and up-to-date information. A reliable supply of energy is central to this country's infrastructure and economy, both under normal circumstances and in times of national emergency. We need energy to continue to operate our industries and facilities, manufacture needed supplies, transport supplies and emergency personnel to where they are needed, operate our communications infrastructure, and heat and cool our homes, hospitals, and workplaces. I would like to express my gratitude to our fellow citizens in the energy industry who are working to provide these essential services to the American people. The CFTC remains focused on protecting the integrity of the derivatives markets. In addition to our own monitoring, we are in daily and often more frequent communication with our exchanges, clearinghouses, and intermediaries. We are committed to ensuring that the derivative markets remain able to fulfill their central purposes of price discovery and risk management. We are also committed to maintaining market participants' access to these markets while not compromising market integrity. To date, derivatives markets have been functioning effectively, but we are vigilant as conditions evolve. The CFTC's Market Intelligence Branch has been leading daily briefings over the past few weeks to apprise commissioners and staff of market developments. During these briefings, the CFTC's operating divisions share key data for the markets we oversee and analyze potential areas of risk. I thank CFTC staff, including our presenters today, for working around the clock to keep pace with these developments and for their dedication to this agency and to the markets we regulate. Presenting today will be three members of the CFTC's Market Intelligence Branch: Chief Market Intelligence Officer Mel Gunwardena and market analysts Chris Goodenow and Mike Nuri. I would like to welcome the chairman and commissioners who are joining today's committee meeting. I'd like to express my appreciation for the chairman's leadership in protecting the health and safety of all of us at the CFTC, and to each of the commissioners for their hard work and collaboration in meeting the challenges we face. Most of us at the CFTC are teleworking in order to protect our staff and our fellow citizens. I'd like to recognize our Office of Data and Technology for enabling us to telework and for setting up this meeting. I hope today's committee meeting will give market participants and the public a glimpse into how the Commission is adapting to the circumstances and continuing to accomplish its mission. I would also like to thank a few people who have made this meeting possible, including Dina Wiggins, President and CEO of the Natural Gas Supply Association and Chair of the EEMAC, Abigail Knopf, the EEMAC Secretary, Lucy Hines of my staff, and Michelle Gim from the Office of General Counsel. Finally, we intend to reschedule the position limits meeting to early May. We will host that meeting remotely if necessary, so please stay tuned for further details from Abigail regarding the format and schedule of that meeting. Thank you.
Thank you, Commissioner Berkovitz. I now recognize Chairman Tarbert to give his opening remarks.
Thank you very much, everyone. And first, let me also recognize all the hard work in the face of unprecedented economic and personal difficulties around the country. Thanks to Commissioner Berkovitz for sponsoring this committee. Special thanks to you, Dina, for chairing EEMAC, and also to you, Abigail, for being the secretary of the committee. I also want to say thank you to everyone on the call today for your insights and assistance to this agency. Each of us recognizes that we have responsibilities to help the American economy continue so that we can overcome the challenges this nation currently faces. The firms that use our markets are driving the world economy and will be vital to jumpstart our economic recovery. Our financial markets, especially our energy markets, are experiencing unprecedented turbulence. But I'm happy to report that these markets are still functioning, and that's thanks to all the dedicated men and women throughout this industry. Our systems are functioning. Margin calls are being met for all major firms, and sellers are able to find buyers. Our energy sector has been hit particularly hard in the past month, and not just by coronavirus, but also by the standoff between Saudi Arabia and Russia on oil production targets. This double dose of volatility reinforces the importance of the derivatives markets, which have allowed participants on every side of this market to manage their price risk. We at the CFTC have been monitoring these market developments. As you know, today we're going to hear from the Market Intelligence Branch of DMO on the many things they have been tracking. A special thanks to all the staff within the agency who have been tracking market developments so that we understand how our markets are functioning. This group has been giving detailed daily briefings to the Commission to keep us abreast of potential issues so we can better coordinate with other regulators and with those of you in the market. We've also been making sure that our regulations don't unintentionally exacerbate problems in the market. Where appropriate, we're granting targeted regulatory relief. Last week, we issued a series of no-action letters to let our registrants comply with social distancing requirements. And on Friday, we issued temporary relief to a bank from registration as a major swap participant. This relief will help ensure that the bank is able to maintain its lending to small and medium-sized oil and gas producers without triggering registration requirements that we hadn't intended to capture it. While we're laser-focused on the turbulence in our markets, we can't let everything else lie fallow. This too shall pass. And I'm reminded by the fact that there are many Americans out there who are in the private sector who unfortunately are losing their jobs and putting up with great economic distress. We at the CFTC are lucky in the sense that we are federal employees, but we want you to know that we're going to continue the business of the Commission. Commissioner Berkovitz stated that we will have the position limits meeting in early May. And I would remind everybody in relation to our position limits proposal, our comment due date is about 5 weeks from now on April 29th. So while we can't have meetings in person with commissioners or staff, we highly recommend that from now up until that date and the EEMAC meeting to talk about position limits, members of the public request phone conferences. Again, this has changed the way coronavirus, the Commission operates, but the agency is still very much open for business. So with that, I'm looking forward to today's presentations on the state of the market, and to all of our staff, to everyone on the call, and to all Americans, I hope you and your families stay safe and healthy during these difficult times. Thank you.
Thank you, Chairman Tarbert. I now recognize Commissioner Quintens to give his opening remarks.
Thank you very much. Let me first thank Commissioner Berkovitz for holding today's meeting, and Dina and Abigail Musi for all the hard work and putting this together under different circumstances than we would normally like. And let me also thank the chairman for his leadership during this time, as well as all of the commissioners and the staff for being so on top of the markets and events and being willing to look at what we need to do appropriately to provide relief or to keep markets functioning. I have a little bit of a different message this morning. I wanted to say, unequivocally, there is no good time to go through something like this. But in my view, and it's only my opinion, there has never been a better time from a resiliency and a preparedness and a capability perspective than right now. From all of the connectivity options that are powered by our entrepreneurial tech ingenuity that allow face-to-face connections across businesses and families and markets and governments, to the productivity and efficiency of our agriculture, our livestock, and our energy producers to provide us with food and power, to the logistical readiness of our supply chain management to continuously stock shelves with necessary supplies, to the expertise and flexibility of our manufacturing sector that can transition from their normal businesses to making critically needed healthcare supplies in a moment's notice, to the implementation of strong business and industry-wide continuity plans fueled by reactions to 9/11, to the unquestionable strength of our banks and our financial system from a capital and liquidity perspective to keep extending credit and absorb shocks, to the integrity and visibility of our derivatives markets for risk management and critical hedging needs. I think we come to this moment of crisis in a time of great strength and preparedness and capabilities, and it's time to execute. And that's exactly what I've seen from this agency and the derivative markets community as a whole. Let me thank MIB, all of our divisions, and ODT for connecting us. We have the resources to do what we need to do during this critical time and to continue our normal business as the chairman has laid out. Thanks again to Commissioner Berkovitz. I'm very much looking forward to the discussion today.
Thank you, Commissioner Quintens. I now recognize Commissioner Benham to give his opening remarks.
Thanks, Abigail. Good morning, everyone. First off, I want to thank Commissioner Berkovitz, as sponsor of the committee holding this meeting, Dina, Abigail, and Lucy, of course, for all of your hard work orchestrating this in a very tough time. I want to thank MIB and all the divisions at the CFTC. As we've heard from the commissioners and the chairman, a lot of work has been going on to sort of mitigate some of the risks and manage some of the challenges that we've seen in the markets in the past month, and all the credit goes to them. I want to, of course, recognize the chairman and my fellow commissioners for their leadership and I think together, collectively, wading through these challenges together and trying to be responsive to the markets in a timely basis. And I also want to recognize all the EEMAC members who are on the call today, some who I've known for many years, and I hope all of you and your families are doing well and are safe as we sort of all, again, collectively sort of endure through this really challenging and difficult time. As a matter of today's meeting and going forward, I think, CFTC has been doing a great job. I don't want to reiterate or repeat the things that have been said already, but we are certainly prepared. We have the best folks in the world in terms of managing markets and making sure that our market structure remains resilient and steadfast through these very difficult times. And as we continue to engage with market participants, which we have for the past few weeks, as demonstrated by some of these relief notices that have gone out in the past couple of weeks, and I think you'll see them continue to be issued in the near future, I think it's important that we be mindful of what everyone is going through at the time, whether it's at home or at work, schools canceled, remote teleworking and whatnot. We have to be mindful of the challenges that folks are facing. And I think as an agency, we need to continue to focus on the critical needs of the market right now. Every day seems to bring a new challenge, new unknowns. And I think we need to allocate all our resources to sort of critical market structure, resiliency, and some of these matters that we could never have predicted but have to sort of step up and address in the short term, in the midterm, and the long term as we sort of work towards a recovery, both economic and social, getting out of this very, very difficult time. So I would certainly encourage folks to engage with the CFTC to the extent it's necessary. I know our doors are open, as the chairman said, but I would hope as an agency we continue to focus solely on these matters in the short term, particularly in these couple weeks where I think with respect to COVID-19, and the challenges we're facing in the business place and at home. We have to be very mindful of the challenges folks are facing, and we have to deal with them in the short-term basis. And I think when this passes, and it will pass, and we will get through it together, then we can continue the business of the agency as we planned and all hope to do in regular routine. So we're here. Really appreciate, again, Commissioner Berkovitz for this. Looking forward to the call, and thanks again to all CFTC staff for their great work during a very challenging time. Thanks. Thanks, Abigail.
Thank you, Commissioner Benham. I now recognize Commissioner Stump to give her opening remarks.
Thank you, Abigail, and thank you for pulling this meeting together in such unprecedented circumstances. I wanted to first acknowledge, there are so many people to thank, but I wanted to acknowledge the way in which the 5 commissioners work together. I think it's somewhat unique, and while it's not unprecedented that we would be very coordinated in a time of unsettled and emotional distress by some, I do think that the way in which the 5 of us interact is helpful in this situation. And I want to thank all 5 of the commissioners, or all 4 of the other commissioners. I've spoken to many of you over the past few days, and I think the way in which we have worked together and put aside our differences to conduct the business of the agency is something that I very much appreciate. I'm very proud to work at an agency where this is where we're able to be nimble enough to do so. Today, I wanted to focus my comments on the mission of the CFTC, which many may know is to promote integrity, resilience, and vibrancy of the U.S. derivatives markets through sound regulation. And I wanted to focus today on resilience, not just as it relates to regulating the derivatives market, but more generally, how it was demonstrated and revered during my upbringing in Texas and how those lessons resonate today. I grew up in an area that was almost exclusively dependent upon production agriculture and a short distance from the Permian Basin, the state's oil-producing region. Both of those industries are critical to the economy of Texas and, in fact, the entire nation. But during my childhood in the 1980s, the agriculture and energy sectors were in a state of turmoil due to depressed market conditions and credit constraints. While these were extremely difficult times, I can attest that the dedication to produce energy and food was never lost, nor was the respect for innovation and markets. In fact, the resilience of these industries is rooted in the trust that if they do their part to feed, clothe, and power the nation, innovators will develop technologies to improve their efficiencies, and markets will operate transparently to help them better manage their risk. My somewhat distant childhood memories now serve as a vivid reminder that our resilience is dependent upon a shared commitment to do our part. In today's environment, public health is everyone's priority. As such, food delivery, expedited grocery restocking, virtual classrooms, school meal distribution, and expanded hotspot locations in areas without internet service all promote stability and social distancing, none of which would be possible without reliable energy sources. As for the CFTC's part in all of this, we have an obligation to preserve the integrity of the market tools for those who produce, distribute, and consume energy during these volatile times. They need all available tools to manage their risk and reliably discover prices on transparent market venues. I am grateful for all of those here at the CFTC who have been carrying out the agency's responsibilities during these difficult times, especially the team that will present today's discussion. This group has worked day and night over the past few weeks. Price discovery is sometimes a grim job, but it is nonetheless our task to fulfill. In July of 2008, I distinctly recall West Texas intermediate crude prices soaring to $147 per barrel. Last week, the same market touched $20 per barrel. In each of these circumstances, we acknowledge that there are real-world implications for consumers and producers, and we must ensure that the price is transparent regardless of its favorability. Only then are these markets able to serve their risk management functions. We also take seriously our obligation to ensure that those who may attempt to manipulate the markets are held accountable. Over the past few weeks, I've been in touch with folks in various commodity businesses. Like the entire nation, they are worried about the public health situation. Like many others, they are concerned about the sustainability of their livelihoods. The commodity production and distribution business is inherently risky, and we as a nation are grateful to those who are willing to take on such endeavors in order that we might eat and power our modern lives. Today we are reminded that resilience is everyone's shared responsibility, and at the CFTC it's part of our mission. With that, I will turn it back to Abigail, and again, thanks to everyone for your willingness to participate today.
Thank you, Commissioner Stump. I'm now going to turn the meeting over to the EEMAC Chair, Dina Wiggins.
Thank you, Abigail. Commissioner Berkowitz, Mr. Chairman, and all of the CFTC commissioners. I am honored to be a member of the EEMAC and to continue serving as the chair of the EEMAC. This committee serves an important vehicle, particularly in times like these, to discuss matters of concern to exchanges, trading firms, end users, energy producers, and regulators within our energy and environmental markets, as well as the Commission's regulation of these markets. A well-informed regulatory environment that understands and fosters open, transparent, competitive, and financially sound energy markets is absolutely critical to our energy and environmental derivatives markets. It is also critical to the hedgers and consumers that rely on our markets to power our homes and businesses, fuel our transportation, and generate jobs and economic growth. As chair, I look forward to facilitating the discussion of associate members' perspectives to the EEMAC and working with the EEMAC members to provide the Commission with feedback and recommendations that assist the agency in its oversight of our markets. To ensure that today's discussion is consistent with the EEMAC Charter, which prohibits associate members from providing reports and recommendations directly to the Commission, we will first take questions and comments from the EEMAC associate members after the panelists have made their presentations and prepared remarks on the respective panel. We will then turn to the EEMAC members for their questions and comments on the panelists' presentations, prepared remarks, and any feedback provided by the associate members. Before we begin our first panel, we would like to do a roll call of the members and associate members on the phone so that we have your attendance on the record. Abigail, could you lead the roll call, please?
Thank you, Dina. EEMAC members, after I say your name, please indicate that you are present. Rob Kramer. Maybe continue. Tribute Bland.
Yes.
Tribute Bland is present.
I'm present. Yeah.
Dimitri Caruso. Bill McCoy.
I am present.
Lopa Parikh.
Present.
Jackie Roberts. Tyson Slocum.
Yes, I'm here.
Thank you. Just to circle back, do we have Rob Kramer on the phone? Dimitri Caruso? Okay. I'm going to move to the associate members. After I say your name, please indicate that you are present. Matthew Agin?
Present.
Thank you. Jim Allison?
Present.
Thank you. Lael Campbell?
Present.
Thank you. Paul Sisio?
Present.
Thank you. Sean Cota?
Present.
Thank you. Daniel Dunleavy?
Present.
Thank you. Eric Heinley? Paul Hughes?
Present.
Thank you. Kaiser Malik?
Present.
Thank you. Timothy McCone?
Present.
Thank you. Robert Mork?
Present.
Thank you. Dr. Parsons? Delia Patterson,
Present.
Matthew Picardi,
Present.
Michael Prokop, Melinda Prudencio,
Present.
Dr. Sandor,
Present.
thank you, and Noha Sidham,
Present.
thank you. And just one last time, Eric Heinley or Dr. Parsons. Okay.
Abigail, this is Russell Lawson. I didn't hear you call my name.
Apologies. Thank you. Similar to other EEMAC meetings, Dina will recognize the associate members and members that wish to ask a question or share comments following the Market Intelligence Branch's presentation. If you'd like Dina to recognize you, please use the WebEx chat icon at the bottom of the screen. Then select the Host and Presenter option within the drop-down menu. Indicate that you have a question and press Enter. Dina will recognize those associate members and then members who wish to speak. Once recognized, please state your name and firm prior to your question or comment. Please remember to place your phone back on mute once you have spoken. I will now turn the meeting over to Dina.
Thank you, Abigail. Today, the Market Intelligence Branch within the Division of Market Oversight will present an update on recent developments within the financial and energy derivatives markets. Mel, could you please begin?
Good morning. Good morning, Chairman. Good morning, Commissioner Berkowitz, Chairman Talbert, Commissioner Quintance, Commissioner Benham, Commissioner Stump, the members and the associate members of this committee. My name is Mel Dina. I'm the Chief Market Intelligence Officer and a Deputy Director of the Division of Market Oversight. Thank you for inviting me and my team to this public meeting of the Energy Environmental Markets Advisory Committee and giving us the opportunity to share some of our information, observations, and insights on the recent developments in the operation of the financial markets with the focus on the energy derivative markets. Our work is only a small part of the enormous work that is being done across the agency under Chairman Talbert's leadership that ensures the integrity, fairness, price discovery, and resilience of derivative markets. I'm joined today by my colleagues Chris Goodnow and Mike Norrie. Chris is the Senior Market Analyst responsible for energy derivatives, and Mike is the Market Analyst responsible for credit derivatives, both in Market Intelligence Branch, which is part of the Division of Market Oversight. Let me start by saying that these views expressed today represents those staff in MIB and do not necessarily reflect the views of the Commodity Futures Trading Commission, any of the commissioners, Division of Market Oversight, or other staff at the Commission. Also consistent with Section 8A of the CEA, this presentation does not contain data or information that would separately disclose the business transactions of market positions of any person and trade secrets or names of any customers. By way of background, MIB, as we call it, was set up in 2017 to strengthen and lead the Commission's market monitoring functions across financial derivative markets. Our work is to support the Commission's mission to promote integrity, resilience, and vibrancy in the derivative markets by monitoring the health and structure of U.S. futures, options, and OTC swaps markets. Our analysis is geared to highlight trends, emerging threats, potential structural or systemic risk to the Chairman and the Commissioners and also the broad Commission. Can we go to the next slide? We do our work by monitoring various metrics and trends, such as the ones I've listed on this slide, including volume activity, liquidity, significant participant positioning, term structures in our contract markets, relative value or convergence of cash and futures markets, news, information, and fundamental analysis. As you can see from this slide, which may be hard to read, we cover over 100 different commodities, indices, and contracts spanning across dairy markets such as milk and cheese futures, agriculture contracts such as grains and beans, precious metals, base metals, the very important energy markets complex, which includes crude, gasoline, natural gas, electricity, to financial markets that includes indices across equities, credit, interest rates, cleared and uncleared swaps, foreign exchange forwards, emerging market non-deliverable forwards, OTC options, and exotics. The U.S., if you can go to the next slide, please. The U.S. derivative markets are approximately $350 trillion to $400 trillion in notional value based on a swap equivalent. The open interest in futures on one side, that means the long interest or the short interest, is between $75 to $100 trillion, where the notional values are not, the option values are not delta adjusted to be consistent with the swaps reporting. Using the BIS swap outstanding notional values in our own data, we approximately about 200 trillion of these contracts are either originated or exist in the U.S. markets. That derives the value of around 350 to 400 trillion overall. To provide some context, in 2008, the futures open interest on one side was about 30 trillion. And today, it's between 75 to 100 trillion. We've seen similar growth in the OTC derivative markets. To give you a sense of market volumes, our trade activity in recent times have reached somewhere in the region of 55 to 60 million contracts a day on the futures side. On average, historically, the contract volume was somewhere in the region of 30 million contracts a day. So as we get into kind of more detail, this slide identifies the major equity market declines that we've observed over the past 100 years, including the 1929 Wall Street crash, the Great Depression, the flash crash in 1962, the long-term capital crisis in 1998, which was also included some of the Asian market crisis and some of the Latin America and Russia debt crisis, the dot-com bubble in 2000, 9/11, and the financial crisis in 2007. As you can see, that these are values from the highest point or to the lowest point to the highest point, and today we've seen some improvement and adjustment in the equities markets at the open. This slide identifies the market volatility as represented in the VIX contract, which touched around 80 last week. In context, to put it in context, the VIX averaged about 15 over the past year, and right now it has moderated a little bit and is in the region of around 55. The COVID-19 disruptions to the financial markets were compounded, as you know, with the OPEC Plus disagreements that became public a few hours prior to the markets opening on March 9. On this day, almost all U.S. Treasury yields, from the 90-day T-bills all the way to 30-year Treasury bonds, traded below 100 basis points for the first time in our history. We have seen whipsaw price action subsequently, including one of the largest percentage declines in history, as well as one of the steepest climbs within 7 days. Over this week, we have seen U.S. yields once again approaching the lower end of this scale. Just switching to more on the currency side, the U.S. dollar cross-currency basis, which is really the swap spread across currency and U.S. dollars, indicating the demand has widened considerably. The Fed actions last week and earlier this week saw some abatement in the overall spreads, that are typically much narrower than the spreads that you see here. It also represents the enormous interest in dollars, both domestically as well as internationally. Just to spend a few minutes on liquidity and specifically on the futures markets. Given the volumes and volatility, all of the exchange-traded contracts have performed very well. The top-of-book depth has been reasonable, and the bid-offer spreads at the top-of-book have kind of widened slightly, but it is consistent with kind of market conditions. There has been a slight slippage of the limit orders and some slippage in stop-loss order fills that are not extreme, and we are monitoring that. None of this is inconsistent with kind of the enormous amount of activity that is taking place in the markets and also some of the volatility in price. In OTC products, the OTC swap spreads have widened a little, probably about 50%, and the liquidity is much lower, consistent again with market activities. In the foreign exchange swaps, we have seen both the TOMNEX, which is kind of the immediate short-term roll to spot value by foreign exchange position holders, and forward swaps have also widened out and have seen some spreads and liquidity drops. There has been heavy activity in the credit derivative swaps markets as long bond holders and hedgers have been actively risk managing. Spreads have widened in more the high yield, energy transport, hotels, resorts, and leisure industries as you would expect in these market conditions. We also look at the various market halts that take place as an indication of price spikes and liquidity. These are halts that are operated by various exchanges in managing price action and maintaining fairness in our markets. Although we've seen an increase in some of these, particularly last week where there has been high volatility, it is consistent with kind of some of the market volatility. As you know, we've had 4 market-wide halts in equity and equity indices. There have been various circuit breaks across various contracts, including crude and treasuries, and we've had many velocity logic triggers, which is what this slide shows, in various markets, including metals, crude, and in interest rates. Now let's focus more narrowly on the crude markets. The 3-month implied volatility in crude markets are at the highest level in the past 20 years. The COVID-19 impact to markets has been compounded by the Russian and Saudi Arabian standoff that has increased market volatility well above the levels observed during the financial crisis, hurricanes, previous disruptions to supply side, production cuts, and even sanctions. On March 9th, the moves in prices in this generic WTI crude contract shows that it's the largest single drop in percentage terms since the Gulf War in 1991. And as you can see from this, we have unprecedented price volatility. The green shows days when we've been up, the red shows prices when we've dropped. And as you can see, at the beginning of the month, we had a price range of around $45, which dropped to a price range of $22.50 recently at the end of last week. This is kind of unprecedented. At this point, to get deeper into some of the energy contracts, I'm going to hand over to my colleague, Chris Goodnow, and who will focus on energy markets.
Thank you, Mel. As you can see in the slide here, which is looking at the global demand forecast for 2020 as expressed by the International Energy Agency. With the rapid spread of COVID-19 around the globe, global demand growth forecasts for crude in 2020 have obviously been revised sharply down, with IEA calling for the first year-over-year decline in demand growth since the financial crisis. These figures were published earlier this month. Since the IEA report, we've seen a number of consultancies and investment banks revise their demand forecast down, calling for even sharper declines, some saying possibly as much as 10%. And if we turn to the next slide, what we've got here, again, using the IEA data, is just a comparison of total supply versus total demand globally on a quarter-by-quarter basis. And as you can see in the 2020 estimates, there's a huge decline in demand in 2020, in the first quarter, which is largely being attributed to China. And they do project demand to rebound across time, but even then, you can see from this graph that the total amount of supply in the market is going to dwarf demand at least through the first half of the year. One thing that I would like to point out is that these numbers do not take into account any changes in production from OPEC Plus participants coming out of their failure to reach a production cut agreement. So right now, based on the last IEA estimates, we're looking at a supply overhang of about 2.9 million barrels per day in the second quarter of 2020. And as I'm sure everyone's aware, with Saudi Arabia and the UAE and Russia talking about increasing production as soon as April 1st, that number could grow to be as much as 7.1 million barrels per day of a supply overhang, again, assuming that everybody follows through on the numbers that they put out into the media. So just to sort of assess where things are at, in the near term, the Russia-Saudi Arabia standoff does add a tremendous degree of uncertainty to a market that's already experiencing significant demand destruction due to COVID-19. And while the Russians and the Saudis do have some of the lowest production costs in the world, both of these countries do rely to some degree on export revenues in order to balance their country's balance sheets. There are some key differences in there in that, unlike Saudi Arabia, Russian currency floats freely against the U.S. dollar, and in the last couple of weeks, the Russian ruble is down more than 15% against the U.S. dollar, which means that since oil is priced in dollars, costs have fallen significantly for the Russians over the past month, whereas the Saudis, who operate on a fixed peg, are still looking at the same cost structure. On the other hand, if you stop to consider U.S. producers in the U.S. oil market, while U.S. producers do have a higher break-even cost than the Russians or the Saudis, U.S. firms make their production decisions based on corporate well-being, and one of the concerns to keep in mind moving forward is, with the current stresses that these companies face, if there's any price appreciation in the near term, this could prompt some U.S. producers to try to generate more crude just to generate some free cash flow to either service debt or to minimize losses, and that could further exacerbate the supply glut. Turning to gasoline markets, what we wanted to talk about here was that much like crude markets themselves, the drop in crude prices and the increasing use of shelter-in-place policies throughout the U.S. have driven gasoline prices down substantially. In fact, they hit an all-time low with yesterday's settlement, and as a result of this steep decline in gasoline prices, the crack spread on gasoline is now negative, which effectively means that if you were just turning oil into gasoline, you would be losing money on every barrel of oil that you turned into gasoline. And what we wanted to show here is, if you go back to the start of the month and you look at the term structure on gasoline, the April, May, and June contracts were all sitting at about a 25 cent per gallon premium to December. And now, prices through Friday, December is actually sitting at, depending on which of the contracts you're looking at, somewhere between a 17 to about 10 cent premium over summer-grade gasoline. So there's some severe demand destruction built into that market, and there's not projected to be any significant price appreciations in gasoline until the end of the year. On this next slide, I'd like to briefly illustrate a potential issue for U.S. crude production in the near term. This slide uses data from the EIA's Drilling Productivity Report and takes a look at legacy oil well production in a number of basins that do have a heavy amount of tight oil participation. And according to EIA's estimates, legacy oil wells, which are wells that are currently in operation, are producing roughly 600,000 fewer barrels per day than they were at their peak. And while this data doesn't directly translate into the decline rate on a well, it does illustrate the point that in this low price environment, as companies sort of scale back on production, we could see overall U.S. crude numbers, production numbers decline throughout the year. And some news that came out this morning, for those who may not be aware, a major oil company has cut their CapEx expenditure by 20% for the remainder of 2020, and they're specifically targeting half of that reduction in Permian Basin operations. And then finally, to turn a little bit towards natural gas, I'd like to take a moment to discuss these markets. And while we've seen increased volatility in natural gas futures prices as COVID-19 spreads and as all markets are sort of shaken by the advancing of the virus, I would like to point out that even though natural gas volatility has doubled in the past 2 months, it's not as volatile as we've seen in past weather events, and this may speak somewhat to the fact that largely the U.S. natural gas market, despite our increases in LNG exports, it's largely still the domestic market. I would like to point out that the U.S. remains well supplied in natural gas, with the total natural gas stocks in the U.S. about 76% above the 2019 levels at this time, according to EIA data that came out last week. And one thing to keep in mind moving forward is that as more U.S. states do start to close non-essential businesses, we could see reductions in commercial and industrial uses of natural gas. And sort of looking at, with respect to the tight oil information that we just sort of discussed, one of the things to consider there is that projected declines in tight oil production would have the ancillary effect of reducing the amount of associated gas. And that sort of thinking is reflected a bit in both the Waha and Permian basis indices, which have gone from negative to positive in the last month. And so just to sort of illustrate that, in the past month, the Waha basis has gone from minus 210 to about minus 110. So if natural gas is trading at $1.60, the Waha basis would actually pay out 50 cents, whereas at the start of the month it would have been a negative basis.
Thank you, Chris. MIB also tracks the ETF and ETN markets, as these directly relate to our derivative markets. Asset managers, as you know, may hedge their requirements or exposure directly or through intermediaries such as banks, and adjust their risk exposure in both futures and swap markets. For unlevered ETFs, as AUM grows or asset under management grows, the asset managers will use the futures markets or swap markets for their desired exposure or risk management requirements. For leverage ETFs, the asset manager will estimate the leverage exposure and hedge in these markets. The growth of the ETF market since the last financial crisis is fairly large, and even as we see some reduction in the assets under management, the absolute open positions are fairly significant in relation to futures open interest. In particularly under these difficult market conditions, those ETFs and ETNs that employ leverage in their funds may exercise some of the optionality that is embedded in them that provides the right to the asset manager to accelerate redemptions if significant price declines occur. As energy prices have declined significantly, this optionality to accelerate may add to some of the selling pressures in futures markets. This slide shows the expanding spreads in the CDX High Yield Index that is broadly traded with over 100 reference entities. A number of these reference entities and reference obligations, which are the bonds issued by those entities, are priced as an index here. You can see that the spreads in the past months have widened from around 300 basis points to around 850 basis points in the high yield, and the blue column, which shows that the investment grades have widened from around 50 basis points to about 125 basis points over this last month. So what we did here was to kind of take a look at where the underlying reference entities are trading. And as we look at the underlying reference entities, we noted that many of the energy, airline, travel, and leisure industries have a higher spread to that of the current market spread, whereas some of the other, the diversification index, allows some of the other types of industries to be at lower than the actual spread. We've also noted that kind of many of the energy companies that are above this line also include 6 out of the 10 that are not on this slide, which is above the 2,500 spread that is here. With that, I'm going to hand it over to Mike to kind of delve down a little bit more into the corporate bond area and into some of the underlying leverage assets that are related to the energy companies.
Thank you, Mel. The last several years has been favorable to high-yield bond issuers in terms of low yields and cost of funding, which has helped support the high-yield bond market's rapid growth over the years to over $2.5 trillion by 2017, as illustrated here in the chart. And as Mel and Chris both highlighted, the energy industry, which has been significantly impacted by the recent downturn, has made up a growing proportion of the index over the years, as also illustrated in the chart here. Moving to the next slide. In a similar fashion, the U.S. leveraged loan market has also rapidly grown and exceeds $1 trillion outstanding. The current environment has made a noticeable impact on the leveraged loan markets, as illustrated here by the chart reflecting the recent significant downward price trend of this S&P LSTA leveraged loan index. Similar to the high-yield bond market, energy companies have also made up a sizable portion of the leveraged loan markets over the last decade or so.
Can you go back, Abigail? Thanks.
Another segment of the credit market that has seen rapid expansion in the last few years is the private debt, or also known as the non-bank lending space, which stood at $812 billion in assets under management as of June 2019, as illustrated in the chart. And as the chart here illustrates, has rapidly grown over the last 2 decades. Particularly as non-bank lending has stepped in to provide credit to middle market companies, as banks have reduced their exposures to this market over the last decade. Now moving to the next slide. Here we're illustrating the investor, back one, Abigail, sorry. The chart here is illustrating the investor composition in the private debt markets, and we can see the landscape is quite diverse, with broad representation from both institutional and private wealth funds actively participating. Now with that, I will hand it back to Mel to conclude this presentation.
Thank you, Mike. The derivative markets have endured historic levels of volatility, record volumes, and lower resting liquidity, but have thus far been resilient and transparent and offering price discovery and an effective risk management capabilities to all our market participants. Clearly, there are threats, and we all across the agency are vigilant, and MIB will continue to perform its role in monitoring, evaluating risks, and provide real-time information and advice to our chairman, commissioners, and the staff in the commission. With that, I hand it back to you, Abigail, for any questions.
Thank you, Mel. I'm going to hand the meeting to Dina.
Okay. Thank you, Mel, Chris, and Mike for that presentation. At this time, I would like to open the floor to questions and comments from the associate members on the presentation. Abigail, do we have any questions pending?
Yes, we have a question from Jim Allison.
Jim, could you read your question and proceed? Thank you.
Jim Allison, JCA Financial Advisory. Panel, thank you for the presentation. Very interesting. Not necessarily a very pleasant presentation, but very interesting one. And thank you for the historical perspective, because the energy industry has been volatile for as long as I've been associated with it. which I will confess is even longer than that long price history you showed. As we look at the clearing business, are we seeing any signs of strains or constraints in the funding liquidity? And if we do see signs of constraints in funding liquidity, are there limitations on the ability of the Fed to intervene, or either gaps in their legal authority or gaps in their ability to intervene to release constraints in liquidity in the clearing business?
This is Mel. We've obviously been watching all of the liquidity capabilities, not just in the generic contracts, but the forward contracts. We've looked at it from the swaps, both kind of more the standardized swaps and kind of the longer dated bespoke swaps. And we've also looked at kind of options, which is important part, and both cleared and uncleared contracts. And clearly, there is a lot of price volatility and some lower order book depth than you would expect. But we also see an increased volume of contracts that are being both cleared and handled through the system effectively. So at this point, I'm not suggesting that there will be disruptions in the future, but at this point, we're reasonably comfortable that the systems that are in place, that have been put in place, the controls that have been put in place, and certainly the infrastructure that supports the financial clearing of these contracts is functioning fairly and reasonably given kind of where the markets are.
So you think the clearinghouses and the clearing members are adequately funded?
I don't look at individual clearing members, but as a broad market, we look at kind of analytics around kind of contracts and volume and spreads and book depth. They seem to be working reasonably well. There are areas within the agency that looks at individual members and clearing houses, and they've not reported anything that is of concern to them.
Okay, thank you.
Abigail, are there other associate members who have a question? Abigail?
This is Richard Sandor. Is the line open? I don't hear anything.
The line is open, Richard. This is Dina Wiggins. Can you hear me?
I can, Dina.
Okay. We're waiting to see if there are other associate members who have questions.
Comment. Very well done, and thank you.
Dina, this is Delia Patterson from APPA. I do have a question. I was wondering how information sharing between the CFTC's, MIB, and FERC's Market Monitoring Group is going.
Hi. Okay, so if I understand your question, how do we share our information? So clearly, on a daily basis, we have daily briefings. We have three levels of briefings. One is a standard briefing in difficult market conditions that we do every day, which we have the commissioners, the chairman, staff engaged, and we kind of go through the status of marketplace. But in general, we provide kind of a morning briefing that we send across the commission, and to the extent that there is any significant or sudden adjustments or moves that needs to be advised, we immediately get in touch and we provide that information. across the various agencies, we have regular conversations with our fellow regulators, including the Fed, the Treasury, the SEC, and other regulators, which we have both on topics specific to market conditions or kind of on a general basis, on a weekly basis. So we're well coordinated and constant touch both internally and externally as we kind of, respond to kind of some of the market conditions.
Thank you.
Are there any other associate members who have a question or a comment? And if you do, if you could identify yourself, please.
This is Sean Cota-Nephi. I have a question on the hard ag commodities. Are we seeing any volatility or stop limits occurring in those exchanges at this point?
As all of our markets have been kind of generally volatile, and as the demand destruction that has taken place, there's been some volatility across the ag markets, similar, not to the same extent as we've seen in some of the financial markets. As a matter of fact, we've been limit up recently in a number of the grain markets, which is kind of, positive. We do constantly monitor across the board all of the agriculture markets to ensure that they have transparency and fairness and their activity, particularly in these difficult market conditions. And we've been working with the exchanges, particularly in some of the markets that have been under more significant pressure, whether it's kind of the livestock market or others in some of the other soft commodities, to ensure that we understand kind of the market structure and kind of, working with others in the division market oversight and also across the agency, kind of monitoring these markets effectively to ensure fairness.
Thank you.
Any other associate members who would like to ask a question or make a comment?
Dina, we have a question from Lael Campbell.
Lael, please proceed.
I didn't have a question, but I thought I can comment. I thought the presentation was insightful. Not the best news. Exelon General is very focused on maintaining the critical infrastructure of the grid right now. That's our main focus on the electricity front. Electricity is going to be very important for getting through all of this. So that's where we're at right now.
Thank you. Are there any other questions?
Shall we proceed to the EMAC meetings members?
I believe so.
Okay. Thank you. And at this time, I would like to open the floor to questions and comments from the EMAC members on the presentation.
This is Steve Land with ICE. I just want to say I thought the presentation was excellent, and from ICE's perspective, we've appreciated the CFTC at being very responsive during this time. Staff, I know that it's challenging for them working from home, as we're mainly working from home too, and they have been very, very responsive for us, which has been helpful. I thought I'd let the Commission know. Thank you.
Thank you.
Anyone else from the EMAC membership? Abigail, are you seeing anyone?
I am not.
This is Tyson Slocum with Public Citizen.
Okay, Tyson, please proceed.
Sure. So my question does relate to the presentations and specifically on the recent no action letters that the CFTC granted, since those no action letters are part of the CFTC's formal response to the significant market conditions that were outlined in the excellent presentation that we just heard. One of the no action letters issued on March 20th was to grant regulatory relief to an unnamed financial entity that has significant loan and swap exposure to the oil and gas sector. And the no action letter excludes this financial entity from major swap participant registration. And I believe that in the opening remarks of the chairman, the granting of this relief was stated that it was intended to allow the bank to continue to loan to the oil and gas sector. My concern here is that the no action relief is granted through September 30th, which is a very long time frame, especially in relation to the other broader no action letters, which are granting relief through June. And while we don't know the identity of the institution, public records do show that, for example, a Bank of Oklahoma, known as BOK Financial, has oil and gas loans equal to 108% of tangible common equity. So this is highly leveraged. They've got over $4 billion in loans. And so my question is extending this type of relief in this very volatile time prudent through September 30th, or should the CFTC amend that to have a shorter leash, if you will? Because in the no action letter, it also appeared that there was an assumption that the oil and price, the oil price situation may be short-term in nature, and I'm not sure that the fundamentals are short-term in nature at this point. So I just had a question to anyone who can answer on whether or not the CFTC might modify elements of that no action letter.
This is the chairman. I'm happy to address that. I appreciate you raising the question. And, you know, look, I think the thinking behind the no action letter ultimately was we don't want a situation where our banks and financial institutions have extended loans. I'm not so sure if it's necessary that they're going to continue, but a lot of them have exposure, and they may or may not hedge that exposure. But given the situation now, they are using our swaps market, for example, to hedge those exposures. And we didn't want to create a situation where at least one financial institution didn't want to hedge its exposure in a prudent manner because it was worried about triggering a major swap participant. So it would hedge its exposure and go over the threshold. There was a lot of discussion among, you know, what should the right date be. I think we settled on 6 months because these are swap positions. But, you know, the idea was to do it during a period of time that could give some comfort, but not extend it too far into the future, but also not sort of grant it for only a couple of months if, in fact, those swaps would stay on the books likely longer than that, or it would be hard to get off. So in the end, I think we settled on 6 months. We'll see what happens going forward. I think anyone else who wants to come to us needs to do it on a one-off basis. I think we were pretty clear about that. It's not sort of a blanket relief, but what we don't want to do is undercut our banking sector if they're trying in good faith to hedge their exposure and their positions. So we will continue to think about it. And one of the things we are thinking about, to your point, is how long should we extend the no action relief? You know, not too soon, but not so long. And you know, we're relying on the expertise of our staff to kind of help us make those critical judgments. So very much appreciate the question.
And I very much appreciate the answer, Mr. Chairman. And I have other questions, but if other, you know, I don't want to monopolize a bunch of time, but I do have other questions, but if you want to see if others do as well, that's fine.
Okay, Tyson, let's see if anybody else has questions from the EMAC membership, and if not, we'll come back to you. Abigail? Any other questions from the EMAC members?
This is Rob Creamer with the FIA PTG as well as Geneva Trading. I'd like to thank the chairman and the commissioners for how just their leadership through this very difficult process. And I've seen it firsthand, and it's made a huge difference. And I think the question that Tyson brings up is very relevant, and I look at it from the perspective of a market participant and representing a group that's providing liquidity in these markets. And I think there is a balance here that we need to make sure that we are taking actions that are going to prevent disruption into the markets. And without taking these fast, swift actions, to stabilize things, the outcome would be a lot worse. So I just want to point that out. I also am mindful that we're coming into quarter end with the capital rules and how these affect liquidity providers. And I want to make sure that that's on everyone's mind in terms of how many strikes in the options markets exist and how all of these, how the risk is being calculated. And I'm just curious if we've had any conversations internally about the capital rules as we come to quarter end, and if there's any relief that might be provided, by the FCMs or flexibility there.
Well, this is Chairman Tarbert again. I'm happy to field that. I mean, the short answer to your question is that we want to make sure that bank capital rules, which are very important, obviously, to the stability of the banking system, don't provide disincentives during this period to supply liquidity, particularly to market makers who are taking critical sides of these trades and allowing sort of the public to enter our markets to hedge their risk. There is the ongoing discussion regarding the current exposure method versus SACR and its phase-in. And so, one of the things that I think people are thinking about is whether or not, since the banking regulators are already going to move to SACR, whether or not they can do so earlier than, let's say, next month, and whether there's some relief there. Ultimately, this is in the court of the banking regulators because, their job is to ensure the safety and soundness of our banking institutions. But this is an issue that we've raised, that if they were going to make changes that we think that they've already decided are consistent with prudential requirements, but at the same time would perhaps provide more liquidity to critical players in our markets, that they consider any measures they can take to make that happen. So it's very much an ongoing dialogue.
Thank you.
And Dina, we have a question from Bill McCoy.
Bill, please proceed.
Yes, thank you, Dina, and thank you again for the leadership and the Commission for hosting this committee meeting during these times. And I wanted to pick up on a comment and a question earlier with respect to the clearing, and specifically it was mentioned, I believe by Mel, that we've seen the increased volume of contracts cleared effectively. And I was wondering whether MIB has observed any corresponding increase in the trading of, say, block futures and cleared swaps with a corresponding decrease in terms of OTC derivatives? Or is this more the case that the increased volume has been along each of these categories? Has there been a migration from OTC derivatives to cleared products?
Not something that is that very significant. There's always kind of volatility and transfer, as you can imagine, during even regular market conditions where people choose different markets to effectively hedge, either directly in the futures markets or in the cleared swaps markets or in the OTC. That's a trade-off that takes. So we do watch to see if there's kind of great transfer of activity from one end to the other, but we've not observed anything that is not within kind of normal bounds and normal bands.
Okay, thank you.
I don't have any other questions from members. Dina.
Okay. Thank you very much for the members for your questions and comments. And at this time, yes?
Dean, this is Tyson. I had another question, if I may.
Oh, certainly. I'm sorry. I forgot to go back to you. I apologize. Tyson, please.
No, that's okay. That's okay. So the question is, again, in response to these unprecedented times, the CFTC has taken what on its face appears to be prudent measures to give some flexibility to a wide array of market participants in its various March 17th no action letters to accommodate the fact that firms, employees have to practice social distancing, traders and other key workers are telecommuting, and so some of the operational equipment that traders and other key players utilize in their offices may not exist at home. And so I understand certain recording and record-keeping requirements have been waived mainly through June. The question is, does the CFTC think it may be prudent to structure in, for the longer term, requirements for firms going forward to have redundancies built into their systems to allow for more remote operations of their platforms and so forth? For example, Reuters is out with an article this morning that many of the trading turrets functionalities can be replicated through different cloud-based software programs to allow traders to continue timestamping and recording transactions the same way that they do in their office. And so is the CFTC looking at the current state of events as an opportunity to enact permanent, long-standing reforms for firms to build in redundancies to deal with a future situation like this? Thank you.
Hi, Tyson. This is Dan. Let me answer that from my perspective. And as these no action letters and issues were brought to our attention, that is certainly one of the questions that was raised that we talked about and discussed internally, whether the existing requirements and plans and redundant capabilities took into account that there might be this situation, and obviously they didn't. And that's going to be, when we get through this, from my perspective, that should be one of the things. There will be a lot of lessons learned in terms of operational readiness and capabilities and redundancies after we've been prepared, and our regulated entities have to be prepared if you're flooded out, and then you can go to a second. You have to have data redundancy and operations redundancy. You can have off-site capability. But frankly, the fact that all your traders or your people couldn't be together, that there would be the social distancing, was not something a pandemic was not built in. And we're going to have to do lessons learned, as I think the whole country is on a lot of things, that what we're prepared for in the future. So I think it's an excellent question. And when we get through this and as we look back on lessons learned, I think that's something that we're going to really have to carefully look at and see what type of remote capabilities we have going forward.
Do any of the other EMAC members have any questions? Or Tyson, does that conclude your questions?
I mean, I could have a couple more questions, but again, I don't want to, hog the mic.
I will give Abigail an opportunity to opine on our time check. How are we doing on time, Abigail?
I think we have time for one more question.
Okay. Tyson, would you like to ask one more question?
Sure. One of the commissioners, I don't recall which one in the opening statement, said that the CFTC has, at this point, the resources it needs to deal with this unprecedented issue. The question is, as Congress is putting together various legislative responses that include beefed up funding for agencies, are there some, do other commissioners or staff have thoughts on additional resources that that Congress can provide in this time?
Tyson, this is Heath again, the chairman. I can answer that. The answer is we do, and we have made that request to Congress. It's modest because I think overall we do have sufficient resources, but given that the agency is also sort of doing some lessons learned right now, we're all working remotely, and that seems to be going quite well. But as I mentioned in my presentation earlier, we expect we'll be holding a lot more meetings like this. So there's some things that we've asked for specifically in terms of resources that will allow us a lot more flexibility in our ability to address some of the technological issues that we're no doubt going to bound to face in the next few months. So we have, in fact, provided our input to Congress and hope our requests are included in whatever piece of legislation is passed.
That's great, Mr. Chairman. Thank you so much. And if there's anything that either individual members of the Energy and Environmental Markets Advisory Committee can do, or if the committee could formally weigh in with an endorsement of increased funding so that the CFTC can do its job effectively, I would welcome that sort of input from the advisory committee.
All right. Thank you to all of the EMAC members for your questions and comments. We'll turn this back to the commissioners. Do any of the commissioners have a question?
I'm not seeing any online, but please feel free to speak.
Yeah, hi, Abigail. This is Dan. Mel, I do have a question. What are we seeing, and what is the market showing in terms of longer dated liquidity in energy markets going out, say, a year or so, and in oil and the related products? Is there liquidity out in the curve, and for folks who are there folks who still want to hedge out there, or what is the are we getting price discovery for a year from now, and what type of liquidity is out there?
Hi, Commissioner Berkowitz. The liquidity is obviously lower as a starting point. So I would just say, in general, liquidity overall is lower by about 30 to 50% across the board. So when you look at kind of book depth or kind of bid offer spreads, mid books, things like that, when you look at the different structures, we observe that generally the liquidity is lower, and that's not inconsistent. It's not unique to this situation, because whenever there is increased volatility, clearly the resting books become kind of smaller. But having said that, we're also seeing a lot of activity going on, and most of that activity is in the shorter term contracts. So up to about a year, we see kind of reasonable hedging activity. There's less activity taking place beyond 1 year, just on the futures contracts. That doesn't mean that there's no liquidity. It just means that there's generally, historically, I think as the hedging needs have changed in the industry, most of the U.S. hedging we've seen is kind of up to a year, very different from previously when it was kind of more longer dated. On the swaps also, we see the shorter type swaps contracts, kind of more active, kind of standardized swaps. The less standardized they become, they are obviously a lot wider. I'm not sure whether that answers your question. It doesn't show as if right now, when you look at a transaction analysis, it doesn't show a lot of activity in kind of, the longer dated contracts, particularly OTC. But at the same time, that doesn't necessarily mean that there is no liquidity, because those are generally bilateral contracts anyway.
Thank you, Bill.
This is Rob Kramer with Geneva. So we're seeing a lot of activity in the sheer number and volume of transactions that we're doing in the shorter dated contracts in the swap markets. So there's a lot of action, and that corresponds to the amount of volume and volatility that's going on through the markets. Markets are certainly wider. Further out in tenor, the liquidity we are seeing is sparse. For people who are quoting, people are trying to stay where there is active liquidity shown on the screen and aren't taking chances so much, providing liquidity further out. I don't know the best way to improve that, but that is a case, and you're not going to really see that liquidity on the screens, and it may be present, as the gentleman suggests, but we're seeing fewer transactions from our vantage point going on several years out.
Rob, this is Dan. So you raise an interesting question. Are members of your group continuing to, in this highly volatile period, and are your members of your group continuing to provide liquidity to the market under these circumstances? How is the general level of participation under principal traders?
Absolutely. We are 100% active, speaking on behalf of Geneva and through conversations with my counterparts at other principal trading firms. They are certainly busy providing liquidity all day long. So I don't think there's an issue there. Certainly the markets are volatile. Markets are wider. The bid-ask spread has widened out. But everyone is fully engaged and just acting very carefully in the markets. And, we've seen some very seismic sort of moves. But I think all of that risk has been well managed by the community. And, I think that everything seems to be going as planned. The only risk that I have, which or thing that's on the forefront of my mind, deals more with the players in the options markets on that capital issue and their ability to continue providing liquidity. It also affects those further out in tenor in the energy markets, where some people with large books might be mindful that they can't take on more inventory, knowing they're coming into the end of the quarter here. But I would say, just to answer your question, I think things are going well, as well as could be expected under the volatility. Let's say that.
Great, thank you.
Abigail, any other questions from commissioners that you can see?
I don't have any, but please, if there are any commissioner questions, please feel free to ask them at this time.
All right, well, if there are no further commissioner questions, I want to thank you, commissioners, for your input and comments on the presentation. I want to thank all of the members, associate members, and particularly the MIB staff for your participation and comments and questions. We look forward to the ongoing work of the EEMAC and our next meeting on a date in the next couple of months. And at this point, I will turn it over to Abigail for further closing remarks.
Thank you, Dina. Before we begin the closing remarks, I want to confirm for the record that the following associate members and members have been in attendance on the call for the court reporter: Associate Member Eric Heinle, Associate Member Dr. John Parsons, and Associate Member Michael Prokop. I'd also like to confirm that Member Rob Kramer has been on the call, and Member Dimitri Caroussas has been on the call. With that, I will now recognize, as we begin the closing remarks, I will now recognize Commissioner Quintens to give his closing remarks.
Thank you so much. I don't have any closing remarks. I'd just really like to thank Commissioner Berkowitz, Deanna, Abigail, Lucy, just all the staff for putting this together. The participation of this committee under these circumstances is so valuable. And again, a big thanks to our market intelligence branch and their daily briefings and herding all of the different divisions together and coordinating the information flow to all of us as commissioners, and echo Commissioner Stump's comments of the privilege it is to work with my fellow public servants.
Thank you, Commissioner Quintens. I now recognize Commissioner Benham to give his closing remarks.
Thanks, Abigail. Again, thanks to you and Lucy and Dina for leading this effort. Thanks to Mel and his team and MIB. Thanks to Commissioner Berkowitz and my fellow commissioners. And, of course, thanks to all the EEMAC members for taking the time, participating, sharing your thoughts. Obviously very critical to us. But given the circumstances and given the challenges we're all facing at home and in the workplace, this is an incredible effort. I do want to thank Commissioner Berkowitz for leading this effort, for adjusting the agenda. I know he had a bigger agenda in mind, but keeping in line with the times and the challenges we're facing today, focusing on what I view as critical information to both the commission, the staff, and the membership of the committee. I think this was extremely helpful. So thanks to everyone, and look forward to hearing from and seeing you soon, and be well. Thank you.
Thank you, Commissioner Benham. I now recognize Commissioner Stump to give her closing remarks.
Thank you, Abigail. I don't have any formal remarks. I echo the thanks that everyone else has offered. Again, I just want to say how proud I am to work with the staff in all of the divisions who are working remotely, but also working around the clock to ensure that we have the information we need and the ability to be agile in these circumstances. And so with that, I will turn it back to you, but thanks to everyone for participating.
Thank you, Commissioner Stump. I now recognize Commissioner Berkowitz to give his closing remarks.
Yeah, thank you. Thanks to everyone. This has been the fact that it went smoothly and effectively. It was a great presentation. Really, when it looks this easy, it never is. So thank you, Abigail and Lucy and ODT, our technology folks, for making this, and Dina as well for your leadership in this, and obviously my fellow commissioners for your support and the great collaboration in addressing what we have to address. And of course, most important, obviously, is our market participants who've taken the time today, and as I said earlier in my remarks, those in the energy industry who are continuing to work to provide us with energy during this crisis. We still have transportation needs and energy needs to keep us going and get us through this. And there are hundreds of thousands, if not millions, of people in the energy industry and the associated industries working to keep this country running. And I want to express my appreciation and gratitude to my fellow citizens for that. One thing that this has really stressed for me as we've been teleworking is the need to actively reach out to others in this time and communicate. That sitting here, not in our normal offices, just all the more important to maintain the telephone lines and the computer. So I would just urge all the members to reach out to us at the CFTC if you're seeing things, want to comment on things. We've got a number of things out for comment. To keep up the communication to us. We really depend on information coming from you. We do the monitoring. We look at the data. We talk to our exchanges. But we also depend on people coming to us. So I just strongly encourage. I still have a open door policy. You can't come through the door, but you can through my phone lines. So let's keep in touch. And thank you very much. And I'll be looking forward to hopefully we can have the position limits meeting in early May. So thanks to everyone again.
Thank you, Commissioner Berkowitz. I'd also like to confirm that we have one more member, Jackie Roberts, who is also in attendance for the court reporter. Thank you to all of the EEMAC members and associate members for attending this meeting. A copy of the slides presented today will be posted to the Commission's EEMAC website in the next several business days. A transcript of the event will also be posted in the coming weeks. Please stay well and keep an eye out for survey dates for the next EEMAC meeting, which will address the proposed position limits rulemaking. This meeting is now adjourned. Thank you.